Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at Bullfrog AI.
If you find our talks useful, please consider subscribe, like, and comment underneath. I want you to imagine holding a winning lottery ticket. You know for a fact it has the jackpot numbers printed right on it.
Okay, sounds like a good problem to have.
Right, but there's a massive catch. The ticket is written in a language that the prize committee they can't read it. And if they can't read it, they won't pay you.
Yeah, that's incredibly frustrating.
Exactly. And that frustrating scenario is actually the exact multi-billion-dollar problem that's currently plaguing the global pharmaceutical industry right now, specifically when it comes to artificial intelligence.
Oh, absolutely. The AI language barrier, basically.
Yeah, and today we are unpacking a microcap biotech company that claims to have built the translator. We're looking at a company that is navigating, honestly, the most treacherous transition in business. They're crossing the chasm from being a cash-burning research project to a fully integrated, revenue-generating commercial enterprise.
And that transition is really where wealth is either built or completely destroyed in the biotech sector.
Right.
I mean, you are looking at an environment that is notoriously high risk, high reward.
For sure.
For anyone investing in this space, you're essentially hunting for that exact inflection point, right? Where a concept finally becomes a commercially validated product. And based on their 2025 annual shareholder letter, Bullfrog AI has officially, planted their flag at that inflection point.
They're saying they've arrived.
Exactly. They are no longer just tweaking their technology in a lab somewhere. They are aggressively pushing for enterprise adoption. I mean, they are selling the intelligence required to actually find blockbuster drugs.
Well, let's talk about the catalyst that put them on the radar, because it is a massive one. They recently secured a commercial agreement with an unnamed top 5 global pharmaceutical company.
Which is huge.
Yeah, it's massive. And this giant is using Bullfrog's proprietary platform, which is called bfLEAP, specifically for drug targeting in major depressive disorder.
Right.
But before we get into the actual tech, help us understand the battlefield here. Why major depressive disorder? If you're a giant pharma company, why do you need an external, microcap company's AI to help you figure out depression?
Well, you really have to look at the sheer biological complexity of the human brain. I mean, if a pharmaceutical company is trying to, say, cure a broken bone or lower cholesterol, the biomarkers are incredibly clear.
You can just see it.
Right. You can look at a blood test or an X-ray and literally see the mechanism at work. But major depressive disorder is not a single, easily identifiable biological broken piece.
It's not like setting a bone.
Not at all. It involves an incredibly complex, interconnected web of neurotransmitters, genetics, environmental factors, subjective symptoms. I mean, for decades, drug discovery in mental health has heavily relied on trial and error.
Just guessing, basically.
Essentially, yeah, because the human brain is this chemical soup that we really only partially understand.
So historically, they've just been throwing compounds at the wall and seeing what improves a patient's mood.
Exactly. Well, slightly more scientific than that, but, not by much. And that traditional approach yields a massive failure rate. So naturally, the industry turned to artificial intelligence to process all this complex biological data.
Which makes sense.
It does, but standard AI, like the kind most companies are using right now, it hit a brick wall. Most AI operates on correlation. It scans millions of data points and says, hey, we found a pattern. When gene X is active, depression seems lower.
Right.
But correlation is incredibly dangerous in medicine.
Because correlation doesn't equal causation. Like the classic example, right? Ice cream sales and shark attacks both spike in the summer. They're correlated, but eating ice cream doesn't actually cause a shark to bite you.
Exactly. That is the perfect analogy. And that's the fundamental flaw of standard correlation-based AI in drug discovery. It might identify a target that is merely a biological byproduct of depression rather than the root cause.
Got it.
This is what the industry calls black box AI. Data goes in, an answer comes out, but the machine absolutely cannot explain the biological pathway of how it arrived at that answer.
Okay, let me try to visualize this. It sounds like a really gifted math student who just writes down the correct final answer on a calculus test, but they absolutely refuse to show their work.
Yes, exactly that.
And to a teacher, or in this specific case, a highly strict pharmaceutical regulator like the FDA, that answer is effectively useless. You can't verify it. You can't trust the process if lives are on the line. And Bullfrog AI is basically claiming to be the student who meticulously shows every single step of their work.
Yeah, that math student comparison actually highlights the core regulatory bottleneck perfectly. Regulators at the FDA, they do not care if your supercomputer spat out a molecule. They demand to know the exact biological mechanism of action.
They need the why.
They need to know why this drug alters the disease. And this is where Bullfrog AI's competitive advantage really lies. They utilize something called causal AI, which creates this massive competitive moat they refer to as the explainability moat.
Okay, break down causal AI for us. How is it actually showing its work?
Well, instead of just looking for statistical overlaps like your ice cream and shark attacks, causal AI maps out relationships as a network of cause and effect pathways. It actually builds a multi-dimensional graph of biological data.
Oh, wow.
Yeah, so when the bfLEAP platform identifies a drug target for major depressive disorder, it doesn't just hand the pharma company a chemical compound. It hands them a map.
Okay, a map.
All right. It says if you alter protein A, it causes a change in enzyme B, which cascades to receptor C, and that ultimately alleviates the depressive symptom. It provides a transparent, trackable biological narrative.
So it gives the scientists a map rather than just a destination. That completely explains why a top 5 pharma giant would actually be comfortable integrating this specific technology into their, highly sensitive multi-billion-dollar workflow.
Yeah, correct.
Because it doesn't replace the human scientists. It just gives them a causal map they can actually take to the FDA.
And securing that contract, that is the ultimate external validation. When a global top 5 player adopts your platform, it signals to the rest of the market that your explainability mode is real and highly functional.
Okay, so if causal AI is the engine that proves why a drug works, how does a company actually package that engine so a giant pharma company can use it daily? Because they didn't just stop at the bfLE platform, right?
That I didn't.
In the first quarter of 2026, they launched an entirely new product that really seems to change their whole business model.
Yeah, they launched a new scenario-based decision engine called bfARENAS. So, if bfARENAS is the tool used to discover the drug, bfARENAS is the tool used to figure out how to actually test it on humans.
Okay, I'm going to need a translation on scenario-based decision engine. How does a software program test a human clinical trial?
Think of it as a highly advanced flight simulator, but for clinical trials.
Oh, interesting.
Because running a phase 2 or phase 3 clinical trial costs tens, sometimes hundreds of millions of dollars. You have to select the exact right patient demographics, set the right dosages, establish inclusion and exclusion criteria.
It's a massive logistical puzzle.
And if you make one wrong assumption in your trial design, a perfectly good drug might fail the trial. You waste years and millions of dollars. So bfARENAS allows pharmaceutical companies to build digital cohorts of patients and run virtual trial simulations.
Wait, really? So they can simulate what happens if they change the dosage, or what happens if a certain percentage of patients drop out of the trial early, all before they enroll a single real human being?
Exactly. They can stress test the entire trial architecture against countless variables. It evaluates their portfolio risks under varying conditions to find the absolute optimal path to regulatory approval.
Man, from a pure wealth-building business strategy perspective, that is a brilliant lock-in mechanism.
It really is.
Because if you're an investor looking at this, you have to appreciate the ecosystem play here. You get the big pharma company using the BFL platform for target identification. Then you hand them bfARENAS to manage the actual trial design. Suddenly, you aren't just a software vendor anymore.
Right, you are the operating system for their entire research and development pipeline.
Yeah, they cannot easily extract themselves from your workflow.
You become indispensable. Competitors offering generic black box AI tools, they simply lack this comprehensive end-to-end capability. And we are seeing the broader financial markets absolutely wake up to this reality.
Which brings us to the market reaction, because the technical price action here has been incredibly dramatic. On Monday, March 30th, 2026, shares experienced what traders call a massive gap up at the market open.
Yeah, a huge jump.
Driven entirely by the news of this pharma contract. But I want to dig into the psychology of the chart here. You noted that the stock moved into a state of reactive accumulation. What exactly is happening in the minds of traders when that occurs?
Reactive accumulation is such a fascinating psychological phenomenon in the markets. Imagine a stock that has been heavily beaten down. In this case, Bullfrog had suffered a brutal 33.6% year-to-date downtrend.
Ouch.
Yeah. The market had essentially priced it as a failing cash-burning concept. But then, a piece of overwhelmingly positive fundamental news hits the wire, this top 5 global pharma contract. The market collectively realizes in an instant that the asset is severely mispriced.
So it's just a panicked rush to get in.
It's a combination, really. Value investors aggressively rushing in to accumulate shares at the depressed price, and short sellers absolutely panicking. This creates a massive volume surge that lands the stock on the lists of top gainers in most active equities. The stock traded up 4.2% to roughly 62 cents earlier in March, and this new momentum pushed it to test resistance levels right near its 50-day moving average.
Okay, let's pause on that technical term for our listeners who might not stare at stock charts all day long. Why does the 50-day moving average matter? Why is that a ceiling or a floor that traders actually care about?
The 50-day moving average is simply the average closing price of the stock over the last 50 trading sessions. Psychologically, institutional traders and algorithms use it as a major trend indicator.
Okay.
If a stock is trading below it, the trend is considered bearish. When a stock surges upward and tests that line, it is essentially knocking on the door of a bullish trend reversal.
So if it breaks through, that's a big deal.
Exactly. If it breaks through that 50-day line on high volume, it signals to the broader market that the downtrend is officially broken and a new uptrend has begun.
Okay, I have to step in and push back aggressively here.
Go for it.
Because everything we've talked about, the causal AI, the clinical trial flight simulator, the massive pharma contract, the technical breakout, it all sounds incredibly rosy. But if you look at the broader traditional financial metrics for this company, it looks terrifying.
It can definitely look that way, yeah.
I mean, the price-to-earnings ratio is sitting at a glaring negative 0.80. And on top of that, Weiss Ratings literally issued a sell rating on the stock. If you're an investor looking at this space, you might see that negative PE ratio and that sell rating and instinctively want to just run the other way. How do you reconcile a revolutionary technology with metrics that are screaming danger?
Well, it is vital to scrutinize those metrics, but you have to read them in the correct context. Let's tackle the Weiss rating sell recommendation first, because context is everything in microcap investing. That specific rating was issued back in January of 2026.
Wait, so 3 months before the top 5 pharma contract was actually announced.
Exactly, and that is the crucial detail. The January rating was based entirely on the lack of current earnings during a quiet developmental period. It is a completely outdated, backward-looking metric.
Right, they couldn't have known.
It relies on data that entirely missed the massive fundamental paradigm shift that occurred in late March. The market in March is actively re-rating the stock from a developmental story to a commercial revenue story.
So a computer algorithm or an analyst looking at historical data in January saw a company burning cash with no customers and rightly said sell, but they didn't know the top 5 contract was coming.
Which brings us to your point about the negative PE ratio. For an early-stage biotech or AI firm, a negative price-to-earnings ratio is not just common. It is entirely standard.
Really?
Oh, yeah. The market is pricing in current losses as necessary research and development investment. You cannot build a cutting-edge causal AI platform or a decision engine like bfARENAS for free. They are burning cash to build that explainability moat.
Gotcha. So the negative PE is essentially just the cost of admission for the future growth.
It is. But here is where the outdated Weiss rating actually creates a highly lucrative setup for savvy investors. Relying on that outdated bearish sentiment creates the potential for a severe short squeeze.
Okay, walk us through the mechanics of that. If I'm a short seller who read that January report, what is happening to me right now?
Well, if you're a short seller, you borrowed shares of Bullfrog back in January and sold them, betting the price would go down so you could buy them back cheaper later. You relied on that sell rating.
Right.
Suddenly, it is late March, and you are caught completely off guard by this massive commercial agreement. The stock price starts surging. To exit your losing position and stop the financial bleeding, you are forced to buy back the shares at the current market price.
And your forced buying adds even more upward pressure to the stock, which triggers other short sellers to panic and buy, creating this cascading upward squeeze.
Exactly. It creates a self-fulfilling cycle of rapid price appreciation. That is the psychological state of reactive accumulation combined with short covering.
Wow. That is a classic explosive market setup. But let's ground ourselves in some brutal reality here. Balancing catalysts and risks is the entire game in wealth building, especially in the microcap space.
Absolutely.
We cannot ignore the balance sheet realities. I really want you to picture the setup because we keep saying the name Bullfrog AI as if it is this sprawling tech campus in Silicon Valley. But as of late March 2026, this is a microcap stock with a tiny market capitalization hovering between $6.55 million and $6.94 million, and they only have 9 employees. 9.
It is the ultimate David and Goliath scenario.
It's staggering. You have a 9-person sub-$7 million operation sitting across a negotiating table from a global pharmaceutical giant that likely employs over 100,000 people.
Yeah, the scale difference is massive.
As an investor, the sheer volatility that a setup like that guarantees should make you sweat a little bit. If you were going to play in this sandbox, you have to understand the severe liquidity risks.
And that brings us to the primary bear case, which every investor needs to understand: liquidity and revenue conversion. Yes, they secured a top-tier contract, which provides incredible external validation. But the actual financial terms of that commercial agreement have not been disclosed.
Meaning we have absolutely no idea if they are getting a giant check today, or if they only get paid a tiny royalty 3 years from now if a drug actually gets approved.
That is the pivotal unknown. Is the contract heavily weighted toward upfront payments? Are there milestone triggers based on clinical progress? Or is it purely based on distant future royalties? Bullfrog's stated strategy focuses on capital-light commercialization via funded collaborations.
Okay.
Typically, those collaborations provide upfront cash to mitigate the smaller company's burn rate.
But if they got out-negotiated by the Goliath, and this specific deal lacks substantial upfront cash, what happens to those 9 employees?
Well, the operating costs of keeping the lights on, maintaining the servers, and funding the ongoing R&D could lead to a severe cash crunch. And a cash crunch in the microcap world almost always leads to one thing: dilution.
Right. If they need capital to survive, they have to issue new shares. And if you are currently holding shares, the value of your slice of the pie just got smaller.
Exactly.
That is the ever-present shadow over microcap investing. So when do we find out? When does the rubber meet the road on these financials so investors aren't just flying blind?
We look at the Catalyst calendar. The next earnings report, whether that ends up being Q1 2026 or their Q4 2025 full-year summary, will be the absolute moment of truth.
Everyone will be watching that.
Investors will be dissecting that report like hawks, looking specifically for revenue recognition from this new pharma contract. The consensus expectation is that we need to see a definitive move toward break-even as commercial revenue finally starts to offset those R&D operating costs.
It is also worth zooming out for a second to look at the macroeconomic environment because the wind is definitely at their backs here. We've talked about the company's internal risks, but the broader industry dynamic is fascinating. Big Pharma is currently staring down the barrel of major patent cliffs.
This is perhaps the biggest macroeconomic tailwind for a company like Bullfrog.
For those who might not follow the pharma industry closely, a patent cliff happens when the exclusive rights to sell a blockbuster drug expire. Imagine a giant pharma company making $10 billion a year on a single medication. Once that patent expires, generic competitors are legally allowed to flood the market with cheaper versions.
And overnight, that $10 billion revenue stream gets completely wiped out.
Big Pharma is desperate right now. They are facing massive revenue craters, and they need AI-driven R&D efficiency to restock their drug pipelines faster and cheaper than ever before. It's not just a nice tool to have anymore, it is a macroeconomic necessity for survival.
Big Pharma has massive stockpiles of capital, but they do not have time. The patent cliffs are approaching rapidly. So Bullfrog AI is essentially selling them time.
Wow, selling them time.
The broader market sentiment toward AI in healthcare is overwhelmingly positive precisely because of that desperation. Pharma companies cannot afford a 90% failure rate in clinical trials anymore. They need the explainability moat, and they need the bfARENAS decision engine to ensure they are placing the right bets.
So we have the causal AI technology that maps the biology, we have the clinical trial simulator, we have the massive validation of the top 5 contract, and we have the terrifying reality of a 9-person company with dilution risks.
Quite the mix.
If we synthesize all of this, what is the final investment thesis? What is the actionable takeaway for the wealth builder listening right now?
Well, taking all factors into account, the technology, the technical breakout from depressed levels, the microcap risks, and the macro environment, we arrive at a bullish score of 7 out of 10.
A 7 out of 10 implies a high potential for reward, but you are keeping a very healthy respect for the sheer volatility of a $6.5 million market cap.
Exactly. Bullfrog has fundamentally de-risked its core business model by validating its platform with a top 5 global player. The launch of bfARENAS positions them as a critical, sticky workflow solution, not just a replaceable tool. With the stock rebounding from its lows on massive volume, it currently offers a highly compelling asymmetric opportunity.
So it's a trade right now.
Right now, it acts as a very attractive swing trade based on the news momentum and the potential short squeeze.
But the thesis evolves over time.
It does. As the market fully digests that they are actively transitioning from a cash-burning concept to a revenue-generating commercial entity, and as we see the financial proof in the upcoming earnings, it evolves from a news-driven swing trade into a highly viable long-term hold.
A swing trade that graduates into a long-term hold. I think that is the perfect framework for navigating the microcap space. But I want to leave everyone listening with a final, highly speculative puzzle to chew on before we wrap up today.
Let's hear it.
We keep referring to this partner as an unnamed top 5 global pharmaceutical company. Think about the actual names on that exclusive list. If, in the coming months, a global titan like Pfizer or Merck officially steps out from behind the curtain of confidentiality and slaps their logo on a joint press release with Bullfrog, what happens to the math?
Oh, man.
How violently could that second stage catalyst reprice a company that currently sits at a mere $6.5 million valuation?
It would trigger an explosive fundamental re-rating of the entire company.
It is the ultimate validation. It's one thing to say you've finally shown your work. It is an entirely different reality when the strictest, most respected teacher in the entire school stands up, points at your paper, and tells the world that you are the one holding the answer key. Keep your eyes locked on that upcoming earnings report, understand the risks of the microcap arena, and watch closely for that partner's name to drop.